Hello, hello. Welcome, guys, to the Educated Homebuyer, live at 5 with myself, Jeb Smith, and Josh Lewis, our resident mortgage expert. We are here to educate, empower, guide you through the real estate process. So if you're new to us, welcome. Thank you for being here. If you're a normal, regular viewer, we appreciate you as well. If you have questions, put them in the comment section below. If you have comments, you like the beards, put that in there too. I think Josh has trimmed his up a little bit. He gave up on the whole thing. So
Got itchy.
Twitters,
It got
and there's
itchy.
those that just continue to push through.
Yeah.
And we see who is who at the moment. Josh, welcome to the show.
I was actually sitting here admiring my little background here after months of whiteness and
Months,
nothing
years.
and nothingness back there. I'm like, I got some greenage, I got a little plant, I got some furniture over there. I'm looking fancy.
Looking fancy. The thing is, they can't see the entire office. They just see that. Actually, the whole office looks good. So you should pan out for everyone to see.
It's getting there. We'll get one and we'll have a Matterport person come in and do the 360 view so you can see the whole thing.
Give them something to look at.
Yeah.
So thanks. Let's talk about a couple things, some house cleaning items, if you will. So we are doing a webinar. There's a poll in the comment section. I put it in there. It's also on my community page, jebsmith.net/webinar. It's going to be, I was going to say July. It's going to be February the 17th at 6 p.m. We are going to go through the home buying process in an hour, kind of a brief overview, if you will, on each. There's going to be 5 different sections, if you will, that we're going to cover. And we hope to have you guys there. That I'll let you add on to that. Josh, anything you want to on a reference on that note?
No. Are we talking in terms of the webinar or the podcast portion?
The webinar for now. We're going podcast here in a moment. We're going to talk about that as well.
So really what Jeb and I did is just sat in a room, which was torture for me, not for him, and whiteboarded out what is it that someone should know. Most of the folks in here, we get plenty of move up buyers, investors, but would you say, Jeb, 85% of the folks in here are looking at buying their first home? One of the most often asked questions that I hear is, hey, so I want to buy a house. What does that mean? Where do I start? It's a version of that. What does that even mean? Where do I start? So, okay, let's start at the beginning and let's work all the way through the end. And it was funny, when we started whiteboarding it out and bullet pointing everything, Jeb, like there's pieces of it that I didn't even think about that we get questions about. Like when we said, so now where we're going to end that webinar is, so now you're a homeowner, now what? There's a lot that first year that you get questions as a realtor. I get questions as a lender, like, hey, I got this in the mail. What the hell does this mean? Hey, well, is this due? What is it? So we want to give you a big overview of everything that you're going to go through, so you'll know exactly what it means to become a home buyer. And it's not only for first-time buyers, because I tell everyone this, most people don't buy homes often enough in their life to be an expert at it. If you haven't done it in 5, 7, 10 years, probably should brush up on what it looks like, because it's very, very different.
No. One of my mentors would say, as a real estate agent, go buy a house every couple of years, just so you know what the people you're helping are actually going through, emotional wise, just through the process. Because as somebody that sells houses, you're not often on the other side, and it's until you go through it, you forget what it's like to be on that side. So it's a good reminder. Sorry to cut you off
Jeb, no, that's great. That's a great thought, because I'll tell you, you refinanced in 2020. Between 2020 and 2021, I've done 4 mortgages, and I hadn't done a mortgage for myself in like 10 years prior to that. I had great rates on everything from the last time things were low and had not done anything. And it was very eye-opening to go through that process. Largely because of government regulations, getting a mortgage is a pain in the ass. We do here at Buywise as good a job as possible to insulate and isolate you from that. But even with me being the owner and me being the person doing the loan, it was eye-opening just seeing things like, this is so dumb. Why would you have to go through this? Why would there be this piece? And most of it's government regulation, and it's all well intended, but was it the road to hell is paved with good intentions? Is that the saying? Yeah.
Yep, that's it. And so the next thing talk about here, not up yet, but working on the podcast, which is going to hit Josh thinks March 1st. I think before that, working on intros and outros and some covers and all that good stuff here. So once that's done, we're going to push this thing along pretty good. And it's going to be a lot of what we cover here. A lot of your questions are going to be addressed in shorter, maybe in a little bit longer format, if you will. But just, some going back and forth, talking about some things directly that we don't address on here, and you don't have to look at our faces while doing it, which will be a positive for many of you out there that just want, some information while you're doing things around the house or what have you. So that is going to be coming soon. We'll keep you abreast on that. But the market, what's happening in the market? So inventory is continuing to increase here locally, Huntington Beach. We've been increasing about 10% each week or since about the last 3 weeks. And you would be like, whoa, dude, that's crazy. That's a lot. But when you went from 69 to 67, 67 to somewhere in the 80s, 80 to somewhere in the 90s, today we sit at 102 when I came on the show. So 102 active listings, which is, hey, that's about 30 more than we had a couple weeks ago, but still substantially lower than where we need to be. With that being said, Orange County, I think we were at 1172-ish, somewhere in that ballpark, 1174, somewhere in there. So we're not seeing the same percentage increase in the county as we have here locally, but it is increasing. So that's a good thing. Properties are still going into escrow. Crazy things are happening all around me on homes, people putting in offers on homes, which we can talk about in more detail. So with that being said, not really a lot of news in the last week. Interest rates are continuing to be the key topic, if you will, the key headline. Josh, let's talk about that. And then we could talk about some news that an article that I sent you earlier today. It was actually an interview. Ivyzellman, super popular out there on the new construction building side, and her predictions, right? She predicted what was going to happen in the last housing debacle, if you will, or she gets the credit for some of that. And she has some thoughts on what's going to happen now, and we'll dive into that. But where are we at rates? Let's talk about it a little bit.
In simple terms, your government stuff, FHA, VA, is plus or minus 3%, depending on whether you want a lender credit, you want to pay a little bit for it. And your conventional is about 3.5, jumbo maybe a little bit above that at 3.625, and the high balance stuff can be a little bit higher as well. So historically, fantastic rates relative to 6 weeks ago, relative to a year ago, not so fantastic. So that's what we're dealing with. Clients just looking at it going, oh, that sucks. And you're like, well, this is historically like in the 98th percentile of available interest rates. So it's important to keep that in perspective. Bigger picture, it's important to keep in perspective what is likely to continue. We talk every week about the 40-year downtrend in interest rates. Nothing that's happening now has convinced me that anything has changed. The biggest thing we look at is large federal deficits in advanced economies around the world are deflationary, and aging populations everywhere around the world other than the African continent. It's deflationary. Technology is deflationary. So you cannot convince me that anything that happened in the last 2 years has turned the ship around, that long-term deflation is massively going to turn, or suddenly going to turn into massive inflation. So it'll be interesting to watch. Jeb and I were talking before we jumped on here. The two guys that I follow the absolute most closely, they both are of the opinion that we're going to get a recession sooner than later, not meaning this year, but next 1 to 2 years, and that will bring lower rates, if not lower than where we were a year ago, but back to those levels. So when you look at it, it's supportive of home prices, it's supportive of people being able to get in at current rates and refinance at a future date. The big thing, it'll be very interesting for us to see this year how the Fed acts. The Fed, you have the Fed chair, and then we've got like 18.
They act a fool.
Yeah, we
Yeah.
got we
No.
got like 18 regional Fed chairs, and they're always talking, and it's interesting to get insights as to what they're thinking and then what they're actually going to do. I don't think they have nearly as much power as they think they do. They could do big and important things, but their options are very limited. So the key thing is going to see, we know they're going to raise rates. That largely impacts the short end of the yield curve and is actually a positive for mortgage rates. The thing we don't know is if they're truly serious about unwinding their balance sheet and selling mortgage-backed securities and treasuries, which would be negative for interest rates. So for the remainder of the year, that's the thing we're going to look and keep an eye on. If we could just look at technicals, the technicals right now tell us we're getting close to possibly a little breakthrough and a little bit of an improvement in interest rates. Doesn't mean they're going back, 3% for your conventional loan, but maybe we get to 3.25. But just keep checking back every week, and we'll give you the narrative as it unfolds.
No, I saw this today. I wanted to post it up here. For many people, it's not going to apply, but let's just talk about it for a moment here. So this is buyer purchasing power, right? So look at what happens with the rise in rates. So the payment essentially, went from 2.75-ish to 3.75-ish, depending on what type of loan you got and when you got your rate and all of that stuff. So obviously, not exactly a linear move there, but it shows you, right, at 3.75, you're basically either paying more money for the same purchasing power, right? So that 1225 went to 1389, if you will, which is what, $160 or so. Or if you want to keep the same payment, you're basically you're going down to a $270,000 purchase price. And that's why people believe that it's going to affect affordability, right? So the question, I guess, is, do you, and in my experience, I will tell you that most home buyers out there, if they're looking at a $300,000 home and rates go up a little bit, they don't say, okay, I'm no longer going to buy 300,000. I want my payment to be exactly the same. I'm now going to look at 270, because guess what? 270 doesn't get you what $300,000 got you, in my opinion, right? So what I often see is home buyers, they have a budget in mind, they have a price in mind of where they want to stay, and what I tell buyers, hey, listen, look at homes in your price point, because the higher you look, if you're qualified for more, if you start looking in that higher, guess what? That home that's priced higher is likely going to check more boxes. And therefore, you're going to feel deflated once you go back and start looking at the homes that were part of your original budget. So the question I guess I have is, Josh, do you think people will look, and again, these are different price points than what we experience here in Southern California, but does the person that's looking, do they now look for less of a house, or are they going to just pay a little bit more and have the same property if they continue to look?
That the second part, it would be my answer, because here's the reality. We all have a breaking point of what we're willing to accept in a property, and that's the right way to look at it. Like, I wouldn't say, hey, if I've got 3 kids and I'm looking at 3-bedroom, 2-bath homes, and I get priced out, I should go buy a 2-bedroom, 1-bath condo. That would be hell. Like, there's better options of that. But I can tell you from our clients, the people we get qualified and approved, some of them, primarily the ones on the lower end. So for us in California, in areas that are still under 500,000, a lot of those people are maxed. They're pinned at what they can qualify. So when rates go up, they have to look down in price. And it can have some impact in those areas. We don't have a supply demand imbalance where it's been able to impact value, but at some point it could. So I think you're definitely looking more. We're in the phase right now that people are just sucking it up and paying more,
Right.
because for the most part, what you qualify for is what you need for a home. What I would say is my higher end clients, which it may sound crazy to you guys in other parts of the country, but loan amounts above $1 million. Those folks, it's more of a choice, but they're looking at it and going, I'm not going to push to 1.5. I'm going to go at 1.2, and just make do, because a 1.2 house is still really nice. Now, my clients that were at 500,000 to get pressured, like, it's not really an option to go 450. A lot of those areas, a 450 single family doesn't exist. So it means switching to a condo. Now you have HOA dues. There's not as much of relief there. So it's been interesting to watch. But anecdotally, from all of the people I'm talking to right now, it's suck it up and make the additional payment and stay in the same price range. And in terms of how that impacts home values for us, Jeb, there's not enough homes for those that are willing to suck it up and pay the extra to buy. So we haven't seen any change to home prices or that trajectory yet.
No. Interesting. So before we get into questions, one more thing I want to touch on, and I meant to do it before I threw that up there, but I, like normal, lose track and start doing something else. You mentioned recession, right? So there are, again, the two guys that you follow the most with regards to interest rates are thinking recession. You and I have talked. We think recession just based on what the Fed's doing, maybe not necessarily this year, but in the next 2 years. And we went back and in a video I've done previously, and we talked about, what the Fed has done in the past to hedge against inflation, if you will. When raising the Fed funds rate, it basically brings inflation down. Interest rates come down, but typically, the stock market also comes down about 10% or so on average. And then what happens is you typically see a recession in about 2 years. So the belief is at the moment that there's likely going to be a recession if the Fed does what they say they're going to do. So what does that recession, what do you think it means, Josh, as a whole? Now, I'm not just talking about home prices. I'm not just talking about rates. I'm talking about just in general. Like, let's talk recession and what the impact that has.
Here's the concern or the worry to me. Our politicians, who are generally dolts and don't know what they're talking about or doing, talk a lot about inequality. COVID took inequality from sort of a fringe thought to kind of the forefront for people that are paying attention. Because if you look at anyone that held assets through COVID, we had massive asset inflation. So COVID was great business for people that owned stocks, bonds, real estate, all of that stuff. So what we also saw is who suffered. It was the folks that were hospitality workers, waitresses, people who needed to be face to face with people. They suffered. Their income hurt. The people who could go work from a computer sitting at a desk did just fine. I think when we see a recession, it's going to be the same thing. That sort of discretionary spending on going to Disneyland or going out to dinner is what hurts, and I think we're going to see more inequality from that standpoint. And I hope there's an answer or a fix to this. A lot of what we talk about. Prior to COVID, we had Jeb, was like a 2-month recession. And when they measure it, you can only measure it in retrospect. And it was like 2 months. It was like the shortest recession on record. If we hadn't had COVID, we probably wouldn't have had a recession yet. And that's going back to when 2009, 2010, when the last recession ended. That's an 11 or 12-year expansion. You go, hey, that's great. That's a great economic record, except it's the lightest, slowest expansion ever. So when we look forward, do I expect, they called 2008 the Great Recession. Do I expect a great recession, a really deep, hard, ugly recession? No, it's probably going to be like the expansion we had for 11 or 12 years. It wasn't all that great. It just takes you to negative growth for a period of time, and it'll be longer than what we had with COVID, which was sort of arbitrary and pushed from outside factors. So it could be 6, 12, 18 months of negative growth, and it could linger much longer in terms of lower growth coming out of it. So what are we here talking about? Mortgages and real estate, and how does that impact things? As long as you have low growth, low inflation, disinflationary forces, interest rates are going to stay low, and that's going to push asset values of hard assets like real estate higher. I don't like it, don't love it, but I just have a hard time making a case for a bubble. Jeremy Grantham wrote an article this week. Jeb, you saw the summary of it.
Yeah.
I did a deep dive, and I'm looking at it and I'm like, Jeremy Grantham's a really smart guy, and he's calling triple bubble in stocks, bubble in bonds, bubble in housing. And you start peeling away at it and you go, it falls apart if you don't subscribe to the bond market bubble. And it's hard to call a market a bubble that's been trending in one direction for 40 years. And there's not any big blow off. Like, you can look at stocks. Stocks went not parabolic, but took a sharp trend upwards during COVID. Bonds dipped, but that was a continuation of a long trend, and it was also quantitative easing where the Fed was buying mortgage-backed securities and treasuries. So when you look at that, I just don't see a bubble in bonds. If you don't have a bubble in bonds that leads to higher yields, meaning to you as a home buyer, higher mortgage rates, I don't see how home values come down for the most part. Now, with that, Jeb, you want to jump into what Ivyzellman was talking about in her?
Yeah, I do. I mean, I promise we'll get to your questions, people, but people, guys, girls,
Don't call them guys.
viewers,
That's
supporters,
inappropriate in
I
22.
appreciate you. But no, I do want to talk about it because all this stuff's important, right? It leads into our thinking and the way we respond to answers. And I think that's important for you guys to understand how we get to where we get, right? We might not be right. It's taking information in from various sources and forming your opinion around it, right? So Ivyzellman, as I mentioned at the beginning of the show, has she was, she follows the building sector of the economy pretty closely. And during the last debacle in housing, I don't like using the word crash just because it's so overplayed in the market, but she basically gave a prediction of what would happen. And she ended up being right with the oversupply and what have you. She has now recently come out in a couple different interviews and made a statement or statements rather addressing her forecast, if you will, because everybody has the question. Now she's some guru. Let's ask her what she thinks about the market. And so if you guys want to see the interview, it was on Yahoo Finance. You can find it. I think it either posted today or yesterday. And it's short, 7 or 8 minutes. And essentially asking the forecast, like why she thinks things are going to, how did we get here for one, right? And so how we got here was not only, people buying primary homes, but a lot of investors, a lot of, ancillary forces, if you will, putting stress on the housing market, buying up these houses. And that's, to me, is whatever. Like who cares, right? How we got here. Let's talk about what the future looks like. And so she seems to think that there is basically an overbuilding problem happening across the United States in a lot of different markets. And once all of that inventory comes to the market, it's going to slow housing. And so I asked Josh, I'm like, where the hell is this housing that she's talking about? Because not happening here locally. And so I guess, again, let's have that conversation. So if you're in a market where there is a ton of building going, then you're probably going to be impacted a little bit more than, say, us in big metropolitan cities like, and I say cities, counties, Orange County, New York City, any of these big cities that the Bay Area where you don't have the construction going on, probably going to be less impacted. But Josh, thoughts?
No, 100%. And I say, let's look back. Where got hit and hurt the most in 2007, 2008 for us in California? It's where they were building. Central California, Fresno, Visalia, Tulare, lots of open land. They were building fast and furious. And those homes that had tripled in value on the way up, like went to like 20% of what they were worth because there was tons of new construction far beyond what was needed for the communities there. I mean, we all know that the Bay Area and Southern California are dense and packed and lots of people want to live there. We saw to a lesser degree Riverside, San Bernardino counties, especially the further portions out of Riverside and San Bernardino, but even areas like Moreno Valley got beat up. The areas that were literally overbuilt, that population density is building up in Southern California, pushing further out where they can build. And as soon as it's overbuilt, those people start coming back in at lower values. So when Ivyzellman's not dumb, that woman is very, very smart, and she has access to more data and better relationships than probably anyone in the housing industry. So when she talks, you would be foolish to go, oh, that lady's crazy. She doesn't know what she's talking about. So she's talking about areas, even like for us in Southern California, where are a lot of people going? They go over to the Phoenix metro. Well, Phoenix has the ability to build and grow more than we have in Southern California. It's much more built out than it was in 2007 when they were building like crazy, but there's much more new construction there. So she's largely talking about the Southeast. Where have people been relocating? You have a migration out of the Northeast and the Midwest down to the Southeast. They don't come to the Southwest and California because it's too expensive, but the areas, the whole Gulf Coast, Florida, up the Mid-Atlantic where you got, where Jeb's from, North Carolina, these areas, better climate, still affordably priced, and they've had really good economies. So those areas have room to build, and I'm not going to dispute her that they may be overbuilt. She largely is talking about multifamily building and also developments of single families that are being built to rent. So not much different than a multifamily. I don't know how that's going to impact home prices, but be careful watching Jeb and I in a Southern California market or Southern or California dominated market in terms of our knowledge level and experience that really has nowhere left to build and hasn't had a lot of building. We're just nowhere near it. And I guess separating that from it, the other way, the other area where I think she's just flat out wrong, she's talking about population growth being at the slowest rate in the last 100 years. And I say, cool. Is it growing or is it decreasing? Do we have a slowing, a decreasing size of the population? We don't. It's just growing at the slowest rate. So we have a shortage of housing, and the population needing housing is growing at a slower rate. That's not a recipe for
right.
It's not a recipe for a supply-demand imbalance. And again, smart woman. If you got her off camera, I'd love to hear her response to that. I've heard her answer it a couple times on camera and just kind of deflects. But it's sort of a red herring in this regard. Pay attention to her data for your area of how builders are building and what supply looks. If you look around and you see tons of new home developments, I would be much more concerned versus an area that has none.
Gotcha. So no, good stuff. I appreciate everyone just sticking with us through that. I mean, I realize that was 28 minutes of us, or 20 minutes or so of us talking about things that don't necessarily address your questions, but I appreciate your support. Appreciate you guys hanging in there. So 223 of you on at the moment. So we're going to dive into some questions. Before we do that, though, I'm going to thank Jeremy for becoming a member. Awesome, buddy. Appreciate it. He actually just made a fantastic comment, which I'm going to go down here and post. I don't. So it goes on to say, Reventure Consulting's videos didn't sit well with me because he's an alarmist. I searched for videos that disagree with him, and they show how he manipulates the data and is in it for the clickbait. So what's interesting here is I actually don't watch his channel. I can't get through it. I watch about 2 minutes and I'm like, I can't do this because it is, there's just so many things to me that I don't agree with in there. But the one video that I did watch a little portion of it, Josh was there too. And it was like, we were talking about migration, and it was, how migration was leaving California and that was going to hurt, California home prices or whatever. But he wasn't talking about net migration. He was using data that wasn't actual factual net migration data out of the thing. So yeah, you can use a lot of, data in a lot of different ways, but just understand when you're out there, what you're watching, just make sure you're, getting all sides of it. Right. I know we all subscribe to things that kind of feed what we want to hear in some form or fashion. Right. That's the nature of the world that we live in. Regardless of what we're talking about, whether it's politics or housing, or you want to hear the things that agrees with you because that's, that makes you feel good. But if that's what you do, just go hear the other side and see what they're saying. And if in some cases, maybe it makes sense, but just dig a little bit deeper. I try to see the other side of things. Josh and I talking about it all the time. Are we missing something here? I'm talking to my friends in different, not only real estate agents, but friends. Like I have a friend that runs a hedge fund in Charlotte. I'm talking to him thinking, buddy, dude, because they're managing a lot of money from a lot of very influential people across that whole East Coast area. Dude, what am I missing here? And we're all having the conversation just to make sure we're, not that we all are in a line, but just to make sure there's not a piece that we're not taking it. So sorry, got off topic there, but I thought it was worth sharing. So there was a question here right at the top of the show that I'm going to address. A
question or a comment? We have a comment deserving congratulations.
Oh, yes, that one as well. So our moderator, Jennifer Lego, finally went into escrow today. I say finally because she has been with us along this journey for a long time, doing the live. She's been here moderating, kicking you guys out in many cases, putting her foot down, bringing the force. And she went into escrow today at the asking price, got a good rate, no points on a deal. So everybody wish her congratulations. Hopefully she doesn't bail on us now that she knows everything about real estate and has a house, but we'll see what happens. But secondly, let's see. Jeremy came in and made a comment or had a question. Let's see here. Was it him? No, it was Joey Crack. So Joey says, in my experience, what factors go into resale values on condos? I think several factors, right? Location's obviously going to be one that is always something that is going to play a part. But HOA dues, HOA fees are typically something that affect resale value on condos. I know you're in New York. Some of these buildings can have super high HOAs, but here in Southern California, where we are, for the majority of condos out there for the longest time, you saw HOAs, about 300, 350. And for a lot of people, they're like, whoa, that's crazy. Depending on where you are, we get it. But now you're seeing HOA fees in some of these condo complexes, $500-$600. And what's alarming to me as a real estate agent is when you see them increase every single year. I mean, with inflation, dues and that sort of thing are going to go up in many cases. But when you see something every single year go up and there's assessments in communities because they've mismanaged funds or haven't done things properly, that's something that you need to pay attention to as a buyer. So all of that stuff goes into resale, but location, price are important. Amenities are important. But HOA financials, how well something's managed, are there assessments, what's happened over, what's the history of that building, that complex with regards to raising dues and fees, all things that you as a potential buyer need to pay attention to. Pay attention to the minutes of the HOA. I mean, many people aren't going to read the entire CC&R document, but pay attention to what the board is talking about in the meetings, because guess what? That's the stuff that's on the forefront. That's the stuff, if they're talking about assessments, if they're talking about raising dues, fees, accounting issues, whatever, that's the stuff that comes up. So that's what you should pay attention to. Josh, anything you want to add to that resale value? I mean, obviously there's a lot that goes into that question, but I'm trying to think of the things that most people don't think about.
In the last boom in like 2000, 2001, 2002, 2003, what we would tell people is condos are like tech stocks. They're volatile. They go up rapidly and they come down faster. Now, since the NASDAQ hasn't been all that much of a leader for the last 10 years, as all of the FANG stocks have actually jumped into the S&P. It doesn't mean much with borrowers, but just it's important to remember they are more volatile. We use in Southern California the example that as you get further inland, those homes are the last to go up and often go up really rapidly at the end of a boom and the first to come down. Condos are similar. We've talked about this before. I own 2 different condos and could tell you good and bad about both of them. Overall, I'm happy to have them. Just exactly like Jeb said, do your due diligence, make sure you read through the paperwork and talk to a few of your neighbors before you close escrow. See what they think about dealing with their HOA.
There you go. That's a good one. But understand, HOAs are like anything else. You could have the best board in the world and people are going to complain, and you could have the worst board in the world. People are going to it's a what is the saying? It's I can't think of it, but basically there's no one wants to be on a board because it's constantly complaining. I've been on an HOA board that was run very, very well, and guess what? The complaining was still the same. So make sure who you talk to, is it the resident complainer in the neighborhood that has a problem with everything. Blast from the past. Heard that self-employment income requirements have changed. Do you know what those changes are, Josh?
So we just got the Fannie Mae lender mortgagee letter, and I have not dug into it. Came out updated February 2nd, 2022. So literally today it just came out. We'll start getting guidance from our lenders. I had a very quick read, so do not quote me on this. It looks like they may be doing away with having to provide 3 months of bank statements to show income is at current levels, or the levels based off of what we saw on the tax returns. When COVID jumped off in 2020, they're like, cool, your 2019 return said your business made $1 million. I want to know that you're not a hair salon that's no longer able to operate and bringing in no money. So we would have to show 3 months of most recent bank statements and the year-to-date P&L P&L, and they needed to line up with that last year's tax return. It looks as though they may have finally eliminated that, which thank goodness. But it is predicated on how recent your returns are. They want at least a 2020 tax return, preferably a 2021, which most businesses don't have yet. But we can update on that next week. But that would be my best guess, is that they just eliminated that overlay or additional requirements for self-employed borrowers.
All right. Important question here. Rams or Bengals, Josh?
Two loser franchises. It's really tough to say. I want to say Rams, but I told you that once your wife leaves and moves in with another dude for 20 years, you don't let her come home. So I'm going with the Bengals.
Oh, look at that. That was aggressive. Aggressive for the local Rams team that we have here. So it's all good.
Although I will be rooting for my Eastern Washington Eagle Cooper Kupp to have 17 touchdowns and 300 yards.
There you go. It's, he's pulling for his alma mater Kupp, but yet rooting against the team. So he wants him to have a really good game, but them still to lose, is what I'm hearing here.
I'm good with that.
I'm going Rams. I think I don't know how you don't root for the local team. I don't have a dog in the fight. I don't.
Yeah, Jeb, you didn't live here when she packed up like a thief in the night and moved across the country to shack up with some other dude. She can't come home. She can't come home.
She's home, baby.
She ain't home, bro.
Makeba. Hey guys, hope all is well. I'm looking to buy in Florida. Do I get a lender in Florida or New York where I'm currently? So Josh, if you're moving out of state, where do you get the lender?
You could do either, as long as the New York lender is licensed in Florida. Since there's so many snowbirds that move off to Florida from New York, it's not that uncommon. But other things being equal, unless whoever you're doing business with, if they're located in New York, make sure they're doing a volume of business in Florida. Every state has its own quirks in terms of how they operate, and Florida is definitely one of those. New York is definitely one of those. So you can get one either, as long as they're licensed in Florida. Just make sure they're doing a volume of business in Florida and understand the local guidelines and regulations.
There you go. Hi, y'all. Can I put two houses on my taxes if neither are rentals? The answer is yes, but you are capped on how much you can actually write off with regards to interest and tax deductions, right? So you're going to be limited based on what that was part of Trump's reform, I think, on taxes, where you're capped at what, 750,000 or so. So you're probably going to be capped. I mean, if one's a primary and you have a second home, I don't know what on the second home you can write off. Can you write off interest on the second home as well?
Up to the 750.
Up to the 750. Okay. So yeah, the answer is yes. And whether or not, the question is whether or not you can actually get any benefit from having them both on there. But talk to a certified tax preparer, CPA, whatever, whoever does your taxes. If you do them, then don't use our advice. Get somebody else's. Joey Cragg, got the title and commitment letter on my condo. Appraisal just took place yesterday. When can I stop worrying about this deal falling through? Also, what can go wrong at this stage? So I would say if you've done your home inspection, and you're satisfied with the findings and or you've negotiated whatever you're going to negotiate, once the appraisal comes back, you're pretty good for the most part. I mean, commitment letter, I'm assuming that's your approval letter from your lender. I mean, you're pretty golden at that point. It's funny. Jennifer Lego, our resident badass here in the community, sent me her purchase contract this morning, and I was looking through it. And what's interesting, so here in the state of California, we have essentially 17 days, the way the contract's written, to remove your loan contingency on there. Most of the time we shorten it. Sometimes we get rid of it. There, it was 30 days. So they have 30 days to get their loan commitment done, which was pretty similar to what we saw in Arizona when I think it was like 3 days prior to closing. Or something along those lines you had and to remove it. So depending on where you are, it looks like you probably still have some sort of fallback to get out of the contract, but sounds like the majority of what you need to focus on is complete. Josh, anything you want to add there?
My answer when I see that is it depends on the quality of the lender that you're working with. So I was going to ask Jeb, did you connect Joey with Ben, the British mortgage broker?
I don't know if we ever connected Mr. Joey Crack, or if he found his own.
So if you went rogue, Joey, and went on your own, we can't vouch. We can't vouch for him. But if you're working with a good lender at the point you're at, nothing can go wrong. It's funny. We have a listener of the show here that we're helping, and we just got clear to close this afternoon, meaning that all of the conditions, you get a conditional approval. Once those conditions are all cleared, the file is clear to close. Then it is truly just connecting dots from there. But she was calling this morning, stressing out about it, and I said, listen. We don't ever have them fall out. We sure as heck don't have them fall out when there's one condition to clear to get that clear to close. So to the point you're at, a good lender is rarely, if ever, going to have a deal fall out.
Good stuff. Let's see here. I'm reading some questions as we're going through this. I should have been doing that.
Joey has a follow-up. We'll just keep on going with the Joey portion of the show. This, in your opinions, what rate is the point that scares everyone off? I think 4.5. Anything over a 4 handle will be psychological, and it'll knock a few people out of the game. We saw this in 2018. Things approached 5%, 4.75, 4.875 for really well qualified borrowers. And it does scare off the people who are thinking that it's a get rich quick scheme, or they might like to own a home. It's serious buyers at that point. So I don't think this is a concern, but you get north of 4.5. It's going to take some people out of the market, either willingly or unwillingly. It will be most interesting to see what happens to the entry level of the market, because those people are much more payment sensitive than our move up buyers.
Right. I'm going. I think
you're going through and reading willings.
He's trying to what's the word?
Seduce.
Seduce was it? Groom.
Oh,
groom. Another viewer towards the wolf side here. Clearly, Simple Name had no idea what was going on there for a moment, asking about talking in code. Then we ask about being a wolf or a cat. Can't tell at the moment. And then we get a response that maybe I'm both. I see the direction this is going, and we'll just see where it goes. We'll see where this whole thing goes. But Willing would like to know, do you have any interest in meeting Ben Carson? Josh.
Didn't Ben Carson die? Didn't he get COVID and die?
Did he?
That's rude. Let's look. Ben Carson. What do we got here? I'm Googling it right now.
I think you're right. I think you are
right. He died
right.
in January of 2021. I'm offended. I liked Ben Carson. He was a horrifically bad HUD secretary, but in general, I liked him. I liked his whole vibe and what he stood for.
Yeah. I mean, the guy was like a brain surgeon, like a neuro, the guy was a stud. Let's see here.
I was going to ask how simple name is saying maybe I'm both. Are your kids too old to remember or to ever played with Cat Dog?
My kids?
Yeah.
What the hell's Cat Dog?
It was a toy that one end of it was a cat and one end of it was a dog. I didn't know what the hell it was. It was Cat Dog. So now I think Simple Name should change their avatar there to Cat Dog.
That's like that horse that's like what the hell's that thing? That's like the human on the front of it. Anyway, let's get back here. I'm trying to find some questions. I know.
Wait, we got bad news that someone broke to me because I've been on the phone for the last 14 hours. Steve Martinez informs us that it's Groundhog Day, which I was totally unaware of, and that he did or did not. What is it? Which one means we got 6 more weeks? He did not see his shadow.
No, when he sees his shadow.
So that's what happened,
I guess. Here's what I'll tell you. Southern California, I'm going to complain, right? It's low 60s outside. I've been here 20 years now. This is the coldest, longest winter I think we've ever had.
He's talking about the long, cold winter.
It is. I've wore more long sleeves during this last 2-month stretch than I have my entire life in Southern California. Now, when I was in North Carolina, different deal. But hey, I'm not for this, bro. If this keeps up, I might be out. I can't do this.
I had to wear
I
a
might go to
sweat.
Florida. I need 70s and 80s, bro.
I had to wear a sweatshirt with my shorts yesterday. It was horrible.
I mean, my wife had me trying on clothes last night that had hoods on them. I was like, what is this, babe? Like, it's going to be 80 degrees any day. And she's telling me, and now I got Steve telling me 6 more weeks. I don't know if I could do it. Let's see here. Lee Miranda, first-time home buyers looking to buy in Riverside. No debt finance. I gave up down payment. I gave decent down payment. We decided to rent for a year and see what the market will be. Then, is this a good move? It's tough. I mean, like that is the toughest question at the moment. Is buying now or should you wait? Right. I mean, that is the question that everyone has, and regardless of which side of this thing you're on, nobody likes the answer. And the idea is that if you're going to be there for some period longer than say 5-7 years, and you got money in the bank, you're comfortable with the payment, I think you can withstand any adjustments in the market. And I think I know I'm not a believer that there's going to be a crash coming, but there's got to be some sort of moderation as to what we've been experiencing. You can't continue to get the craziness that I'm seeing on some of these properties and the offers, and just it can't continue forever, right? So there's got to be a leveling off at some point. And if you had a 2-year horizon, I would say I don't know what's going to happen in 2 years, but I think if you got a 5, 7, 10-year deal, you can withstand any of those adjustments. I mean, you hear Josh and I talk all the time. I often say this: people are too concerned with their house price. I mean, way too concerned. If you're going to buy a house and you're comfortable with the payment, that's what you should focus on. Too many people are worried about the day-to-day value of their home. Like, who cares? Like, I don't think about the value of my home ever, right? I think about, okay, on the first, this is how much is due. That's it. And that's what I think about, because it's not a stock, right? The gain, the loss, whatever you're experiencing isn't neither until you decide to sell that property. And if you're smart, you end up keeping that property regardless of what happens. And hopefully you're in a financial position to just buy the other one and keep the other one as a rental. That's the way you got to think. I mean, here's the rents are going to continue to rise. They are. Inflation, it's probably going to moderate, or it's definitely going to moderate. The question is it going to be 3 months, 6 months, a year? Inflation is going to come back down. The Fed is at some point in the next couple of years going to have trouble hitting their 2% target that they've had trouble hitting forever. That's going to be reality again. But rents you're not going to see a big decline because you're not going to see much change, right? There's a lot of investors, a lot of big funds out there buying property because renters need a place to live. And so, if you can fix your payment, hedge yourself against inflation, owning real estate's the best way to do that. I think if you're in a position to buy, it's that time of your life where it makes sense to buy a home, then pull the trigger. It's at that time in my life right now where I'm outgrowing the house that I'm in. I'm looking to buy something else, right? I'm not sitting here telling you guys you should buy a house because, whatever. I'm telling you that's what I'm looking at. I tell Josh all the time. I mean, I'm looking at property constantly because I'm looking to pull the trigger on something. So that's my thoughts. Josh, thoughts?
No, same thing. I had this conversation. We had some folks come in. I did an open house for my property in Orange. We're looking for a good tenant. We got some nice kids in there. But so a lovely couple came in and they're telling me, well, we just gave up. Basically the same story here. They were looking in Orange, Tustin, in Orange County, and they said, we just gave up. Prices are too high. And we had a hour-long discussion. And for them, we went through it, and like, it just makes more sense to step in and buy. It's not fun. No one's looking around when 24 months ago what the same dollars would have got you or how much less you could have paid for the same thing. But if you're at the right point in life where homeownership makes sense, and you have a longer term time horizon, it makes more sense to do it now versus wait. I just don't see any massively better entry point coming at some point on the near term horizon.
There you go. We're going to move along here. Josh, you get this one a lot. I know there's not an easy answer to this one, but we're going to throw it up there. Buying a new build. What do you do? Expected date of completion is May or June. So I actually have a video coming out on Friday talking new construction. So want to know my thoughts on new construction? Watch that video. It'll get posted Friday midday. But Josh, what are your thoughts on locking a rate?
We have a couple clients doing new construction. For them, they're lucky. It's more like late April, so we're getting close to being within inside of 60 days. I really don't like locking on anything longer than 60 days. You have to believe strongly that rates are going up. So there's some technical points where if we saw a breakdown, we would suck it up and lock. In terms of right now, I would be watching very closely those technical points in the market. But for now, I don't believe I would recommend locking. And to get you all the way out to June, even the first part of June, so that's 5 months into the year, when we're got 120 days, you need a 120-day lock. Have your lender price out what a 120-day lock looks like versus a 30-day lock, and that'll tell you how much the market has to move before you'd be in a worse position floating out to that. I'm not super hopeful that between now and June we're going to see better rates, but I also am not confident that we're going to see higher rates.
There we go. Let's see. I had a question I was going to click on. Oh, here we go. Bill D. What is the bare minimum one must do for a new home to count as a primary residence? Can I buy a house, keep one as my office, and rent out the rest of the house? So, Josh, I've signed the owner occupancy affidavit saying this is my primary home. That's why I'm buying it. What's the next step? Like, what makes it a primary?
Remember all last year what the question was. How long do I have to live in this before I can go buy another property as my primary residence? I'm going to take cash out, do an owner occupied loan, and then I want to go buy another property. This is a version of it. You are saying you are going to occupy the home as your primary residence within 60 days of closing. So if you're talking about buying it, you cannot buy it and keep an office there, keep your tractor in the backyard, use the garage. You have to own and occupy the property as your primary residence. Now, that being said, there's no occupancy police. They don't come out and knock on your door. They don't look in your windows and see whose stuff is there. They don't ask for your utility bills. So the likelihood of getting caught and having a problem is very low. It comes down to what does it look like on paper? Does it make sense? I've given probably 4 examples in the last year of people who did owner-occupied loans, and we did owner-occupied loans within 4 or 5 months. One of them within 45 days of doing an owner-occupied loan did another owner-occupied loan. You just have to make a very good case for it. The underwriter has to document, and at the end of the day, the underwriter doesn't have the right or the ability to call you a liar. It has to make sense, and they have to document you saying why you're going to occupy. And there is always the possibility that if you didn't occupy, they can call the loan due that you got the loan under false pretenses. I have never seen it happen, but doesn't mean that it wouldn't or couldn't.
No, absolutely. Good answer. So it's becoming that part of the show where I always reach out to you guys and beat you over the head and ask you to hit the like button. It helps more people see the video, the live feed in their feed. So I appreciate you doing that. If you find any value at all, I hate asking this, quite frankly, but there's 270 of you in here, and there were like 70 likes. So we're trying to get to 5,000 tonight.
It's going to be hard. It's going to be hard. You're going to have to roll over those 270 people about 20 times with all of them liking.
I'm going to do what it takes. And if you don't follow, hit that. So thank you guys. And lastly, I will mention this. So there's a poll going at the moment in the channel. Josh and I are going to do a live home buying webinar 2 Thursdays. So not this coming Thursday, not the next one. No, 2 weeks from now, on Thursday, 6 p.m. Pacific Standard Time, an hour. We're going to go over the home buying process, basically 5 different segments, modules, if you will, get you dialed in on buying a home. There's the link to register if you want to check that out. And that's the last thing I'll do before going back and answering some questions. So Simple Name says, Jeb and Josh, how much would it cost how much would a house cost being 1,000 square feet on an acre in the South with a water line that runs over I have no idea.
That's a spectacular question. That's like
it is.
an SAT test question where you have to give a,
like you got to work fast. You got to use a hypotenuse to figure out the angle of the water line to the house. No, I honestly have no idea. What I can tell you is that I'm, like I mentioned this last week, rural North Carolina. And my family, my aunt, who essentially raised me, just inherited her father's house. And so it's been around, he's been paid off a long time. So she's actually going to move into that and sell her house. And it's incredible. Like the demand there is the same, right? She lives on, I don't know what it would be, probably quarter acre or something, but these houses are going to sell at a premium. And it's, for the longest time, these homes never appreciated in value, right? They were the same price for 10 years. And now all of a sudden the demand is there. And so, depends on the area that you're in, but I can't really answer the question directly just because I have no idea. And the whole water line thing, 4 miles, like that's a whole different animal in itself. Let's see here. So this is an interesting comment. Derek says, or question rather, I've seen houses go from coming soon directly to under contract. How is that possible? Is it legal? The answer is absolutely legal. I will say that I'm guilty of it. Personally, here in the last 2 to 3 weeks, had 2 properties listed as coming soons, received 2 offers on, these are 2 different properties, 2 different buyers, 2 different everything, off market, offers on properties that were presented to seller. My job is to present these offers to the seller. Seller basically decided 2 different sellers, 2 different properties, 2 different everything. And both were accepted prior to going to the market. Both were unique scenarios in the fact that one was an older lady. The other one was not recently divorced, but going through a divorce, kids, pets, that sort of thing. House was a bit in disarray, didn't want to have people in the house. And so the idea of listing it to begin with was kind of, frustrating. So the fact that somebody was willing to buy it without doing any of that was something that they considered. So I'm seeing a lot of it at the moment. In fact, I'm personally trying to get a seller to potentially consider an offer here on a property that is on the market as a coming soon that they're not going to allow showings until this weekend. So, don't be afraid to try to get in there prior to that. But sometimes it's tough, but it is legal. Just understand it's frustrating. I do know that. So anyway, Joey, again, minimum amount of equity lenders want for refinancing and the minimum amount where it simply makes sense to refinance.
Equity position is irrelevant as to whether it makes sense. Equity position is definitely relevant to whether you can or cannot. If it's an owner-occupied residence, you have all the options in the world. The same LTVs apply as purchasing, 97%, 95, 90, 85. If it's an non-owner property, strange paradox is you can buy a non-owner occupied single-family residence with 15% down, but you can only refinance once you have 25% equity. So just a weird quirk of the system. But for your primary residence, if you were able to buy it and it didn't drop in value, you're able to refinance it. When does it make sense? We've talked about it before on the show. Simple rule of thumb, take $125,000, divide it by your loan amount, and it'll tell you how much you need to save in interest before it makes sense. So for us, common refinance loan size here in Southern California is 500,000 or so. Take 125, divide it by 500. It tells you need to drop 0.25% before it makes sense. And people always love to ask, why? What's the magic? Can you reverse engineer it and show it to me? I have no idea, but it works every damn time. If it's less than that, let's say if you were saving 0.1% on a $500,000 loan, when I show you the options and you know the work that goes into getting the loan, most people just go, no, it's not worth it.
No, that and also it has to do with rate. What you're being charged to do that loan, right? So sometimes that math might not work because somebody's charging you an arm and a leg with regards to points, fees, whatever, where the math just doesn't work. So make sure, again, you're using whatever it is you're saving if it's $50 a month, but it's costing you, somebody's charging you $5,000 to do that loan. Well, take that 5,000, divide it by 50. How many months is it going to take you to recoup that? Does that make sense to you financially? Right. So but a good lender can explain all of that to you. And if you need one, there's a link in the description below. I'm not going to throw another link up on the screen at the moment, just because I just berated you guys with one. But you guys know how to get in touch with us. We can put you in touch with somebody that can guide you in the right direction.
For the most part, with that rule of thumb, Jeb, you're looking at 0-point loans. If you start paying points, you better be saving more than that, just because your recoupment period looks so long. We've had a lot of issues with that. VA changed their guidelines a few years ago in terms of eligibility for an IRRRL, the income interest rate reduction refinance loan, and FHA had to do the same thing a while back, because you had these call center operations who send out 1 million mailers and say, hey, I can get you this amazing rate and it's going to lower your payment. I'm only going to charge you 4 points to do it. So for the most part, you shouldn't be paying points for your refinances ever.
And I lied, and I put a scroll on the bottom.
Put more links
instead of a post. So I'll leave it on there for a sec while we address this question. So Bobby asked, would you listen to family and friends' advice on whether to buy a house in this market or not when you are in a great financial position and can easily afford the home? It's a tough question because if you trust these people, you trust their advice, it's hard to just disregard it. But at the same time, what I will tell you is, as a real estate broker, and family, friends, the parents at school, everybody knows what I do. I always have conversations around the housing market. And I will tell you, at the moment, there's a lot of people out there that believe you shouldn't buy a house for one reason or another. And I'm constantly having those conversations, or listening to people having those comments, because oftentimes I don't get into debates about it, just because I talk about it so much. I don't want to continue to talking about it, off camera and off conversations with clients. Otherwise, I wouldn't talk about anything else. But just understand, whoever it is you're getting advice from, make sure that they're in a good financial position and, have set themselves up in the right way. Because if you got somebody that doesn't own a home telling you that you shouldn't buy a home, that's one thing. I mean, right. But I mean, if these people are all homeowners and have done this many times, maybe depending on your area, maybe it might not be right. I mean, real estate's local. I mean, that's what you got to take into account. It's not always yes or no. Just look at the circumstances surrounding you. Josh, you're going to add something.
Yeah, let me give you an awesome real world example. My aunt, who may be watching here, my wife and I bought our home in 2003 for $580,000. Very similar, but maybe 400 or 500 square feet bigger than the home that my aunt and her husband bought in like 1978 for $70,000. Her mind could not grasp that $580,000 was a realistic and reasonable number, and with the best of intentions said, I think you're crazy. Like, I don't think that makes sense. You can't buy that house for $580,000 and expect to come out ahead. That house from 2003 to 2008 went up to, probably touched about $1,950,000, maybe $1,050,000, somewhere in there. And when it came back down, because I'm in a really good neighborhood, we didn't have nearly as bad of a downturn as anyone else. It probably got just a hair under 800. So 580 up to almost $1 million to just a hair under 800. And now we're sitting somewhere $1,400,000, $1,500,000. So be careful, even here. I mean, everywhere in the United States. But if you're here in Huntington, the homes that are now selling for $1,500,000 in 2010 were $700,000 houses. So people are looking at that going, you're nuts. 10 years ago, I could have got that house for $700,000. Well, that's a cool story. It has nothing to do with anything. It was way underpriced at $700,000. So just be careful of where they're coming from and their frame of reference. Like I said, my aunt's awesome, smart lady, loves me. She wasn't saying it to be a turd, just from her frame of reference, from getting a very similar house that was brand new when she bought it for, 1/7 of the cost or 1/8 of the cost. Couldn't wrap her mind around paying that price and it working out well.
There you go. Miguel's asking feedback on Charlotte housing market. Good to buy, invest. Don't know it well enough. Obviously, I'm being from North Carolina. I have a lot of friends in that area in all forms, fashions. I mean, I think it's like anywhere else. You got to make the right decision for you financially if it makes sense. It's a metropolitan area. I know there's some building on the outskirts of Charlotte, but not Charlotte itself. I mean, it's a lot of the cities that are, that most people have never heard of is where they're doing the building. So depending on where you're looking, if supply is low, chances are demand's probably high and the market's going to do fairly well. But I know that, Charlotte is one of those areas that 20 years ago, nobody wanted to live in Charlotte. It was a crap hole. Now, Charlotte's come a long way, right? It's changed, dramatically over the last 20 years just because of the infrastructure and everything surrounding it. So it's a popular city. Not much is going to change. A lot of people want to be in North Carolina. So I would say that it's probably going to continue to do fairly well. But again, talk to somebody local there. And if you need somebody, as I mentioned, that link's in the description. I can connect you. Here's a good one, Josh. Realtor had to offer a tight closing 15 days to go into escrow. Now we on day 15 and the lender needs 7 more days. What's the likelihood of the seller services you? Wow, I don't know. That would be a really aggressive ask. I mean, quite frankly,
my wife might not like that.
Sorry, we just took a turn for the worse. The likelihood the seller would basically take your deposit. In my experience, I've had many transactions over the course of my career that haven't closed on time. Fortunately, knock on wood, I've never had a seller take a deposit. So chances are you're that far into the transaction, the seller's likely to work with you. The selling agent's likely to work with you. But here's the key to this whole thing: communication. If they found out on day 15 they needed 7 more days, I mean, it'll probably still happen, but that's tough, right? The lender knew before today that they were going to need more time. And that's something that probably needed to be discussed going into this. Now, communication's key through this whole thing, right? If there's delays because of appraisal or delays because of, employment verification or whatever it is, or maybe it's delays on the seller side, right? Just that communication gets you a long way. It's just like anything else. But when you find out on the last day, or if you've been promised loan docs, right? Somebody should have been checking, hey, where are we with the loan? All this stuff. Finding out the last day, oh, we don't have anything. Well, if you promised it, that's a problem, right? But if you've been open, a little less problematic, I would say overall you're probably okay, but you just need to make sure there's communication going forward. I mean, as a listing agent, I want to know, why are we delayed? How are you going to guarantee me we're going to get there? And in some cases, there might even be a per diem or something per day. It says, hey, listen, we're willing to grant you this, but this is what we're going to ask because, we're basically, putting ourselves out there, if you will. So hopefully everybody's fair and reasonable. Josh, thoughts?
Here's the thing. I have never had it happen to a client, but it's largely because of what Jeb said. Communicate. If there's an issue, something comes up, hopefully your lender talked to the listing agent before they accepted that offer, explaining why 15 days was reasonable. And hopefully they have a very good reason why 15 days didn't work out and now it's 22 days. The thing that any realtor is going to rightfully be pissed about is someone assuring them they can do something that they never had the ability to do just to lock up the property. Because the reality is, even if they could find another buyer right now who could perform in 15 days under the same terms, they would still be 15 more days out versus 7 from this lender. So they're going to choose the path of least resistance and go with you as long as they can get some assurances from your lender that 7 days is a reasonable number. And they probably want to know why in the hell 15 days wasn't a reasonable number that they agreed to. The other thing that I would say, Jeb, I get this all the time. So we talk about the importance of your lender reaching out and following up on every offer and trying to talk to the agent ahead of time. Had 2 or 3 different ones come up this week, and amazingly, the common refrain from the agents on the other side is, awesome. Before we accept this offer, I wanted to talk to you. I want to make sure that we can talk, that we're going to have open lines of communication. And I understand shit happens, things go wrong, but just talk to me and let me know if it happens. 3 different variations of that same exact conversation. And unfortunately, a lot of people in our business, both real estate and mortgage, don't follow that. Like, people can deal with the truth. What they can't deal with is you hiding behind your phone and not talking.
Right. No, good point. I mean, I told this story a couple months back. but I think it's important because we're talking about communication. I had a listing a couple months back, and it was the seller was selling that property contingent upon finding a replacement property. We were in escrow on her sell, on her listing, and we went into escrow on the purchase. And her deal fell out of escrow two or three times, because of various reasons with buyers and what have you. So each time I had to call that listing agent that we were in escrow on the up leg and say, hey, here's the deal. Like, I've got multiple offers. We thought we selected a solid buyer. It fell apart because of X. We've got other buyers lined up. It's probably going to cause a delay or what have you, and whatever. And obviously it was stressful. It was stressful for everyone. I didn't want to make that call because I don't like giving bad news. The listing agent was super cool, worked with us. The seller was super cool, and ended up between that whole thing, because we got the last buyer to actually go shorter term on the escrow. I think they did a 21-day instead of our original 30. We ended up closing essentially with our original schedule. It was crazy that it happened, and there was really nothing to be alarmed about at the end of the day. But the fact was, there was communication that entire time. And so if we had been a week late, we had already prepped them for it, but we actually under promise and over delivered versus the other direction. And I've been on all scenarios, and you just communication, nobody wants bad news, but guess what? With bad news, you can actually make informed decisions versus not having any news at all and wondering what the hell is going on. That's not good for anyone, right? I mean, you want to be able, the quicker you as an agent or whatever get the bad news out there, it's off you. Like, it might suck, but at least you don't have it hanging over your head. And a lot of people out there just don't want to have the conversation, so they just keep it up, and it just turns into way worse situations. So just make sure the conversation's being had, and you should be in good shape. PsyOps. Any thoughts with FSBO? Could you do a segment on how to process? No, I don't really have a lot of thoughts on it. FSBOs make up, I forgot, I just saw the percentage the other day. It's basically less than 1% of the sales that actually happen in a year are FSBO. So it's a very, very small percentage of the population. Number of transactions, maybe it's like 2%, but it's a very, very small number. I don't come across them very often. If you are buying a for sale by owner, just make sure that all the proper paperwork is there, because there are still, and if you're doing one, you're selling one, you need to make sure that you do the proper paperwork, because it can come back to bite you by not having the proper disclosures. Here in the state of California, there is a ton of paperwork that are associated with every transaction that sells, whether it's a for sale by owner or another transaction. And you don't do proper paperwork, that stuff can come back to bite you if something is found or not disclosed or what have you in the future. So other than that, don't really have a lot to say about it. Again, because I don't really do very much of them or not involved in them.
Had one,
Yep.
Jeb, just this week.
Yep.
Someone contacted me from the show here.
Yep.
Hey, working with a seller. They're in a little bit of distress, want to sell the property. We got a great number. I was excited for him. Asked for a contract. I gave him the first Tuesday contract that you can get online. You don't want to really use a realtor contract if you're not a realtor. He went, got it signed before they could open escrow, changed their mind and went a different direction. And that stuff is not that uncommon, just because when you have principal to principal negotiations, there's a reason why it's helpful having realtors, professional negotiators sort of in there buffering. So I see every year we do probably 5, 6, 7 loans on FSBO transactions, and some of them work out wonderfully. A lot of them fall apart before they ever get to that point. And what I can say, most of them, the sellers are completely and totally non-compliant with what their disclosure guidelines are in the state of California. And I'm sure those disclosures are not all that different in other states.
There you go. I'm just going to follow up to something Jennifer just said in the chat. Don't repeat the questions, guys. If you put a question in, you leave, you didn't get your answer, sorry. If you continue to repeat questions, we ignore them. There's a lot of questions. Obviously, try to go into some sort of order here, sequence. So bear with us. We'll get to them. And if you want, just put your question here and go back and watch it later if you don't have the
Jeb,
time.
Jeb,
Yep.
what I have to say to those folks is we have to make time for the important questions and comments. Simple Name pointed out that last stream, we didn't know that today was Groundhog Day, and today is Groundhog Day. And once again, we did not know it was Groundhog Day.
So it's kind of like Groundhog Day.
Kind of like Groundhog Day. Interesting.
I get it. I like it. This is genius stuff, guys. Nate and Jess are asking thoughts on 30-year fixed in November. I don't have one. I mean, I said a lot of the Fannie Mae, Freddie Mac, a lot of these organizations are predicting 4% by the end of the year. I'm going to stick with what I've said so far. I don't know that, I said high was going to be somewhere around 3.75. For the time being, I'm going to stick with that. Even though we're kind of there, I don't know that much is going to change on that front. So that's where I'm going. Again, I don't really have a forecast, so to speak. We got to wait and figure out what these guys are going to do and how it's going to play out. Right? There's just unknowns that need to happen on the side of the Fed, with the Fed funds rate, with them selling their balance sheet, with all of that stuff. How does the market look at it? And at the moment, I have no idea, right? They change their language. It changes people's expectations. Expectations change how people react to things. So for the time being, that's where we're at.
The answer to the question is there's no answer. Like, just, you can't walk into a casino and know that you're going to win the next hand of blackjack. But if you can count cards, you know when the odds are in your favor. So let's look at what we do know. We know the Fed's going to stop all of their buying by the end of the first quarter. We know as soon as that happens, they're going to start hiking rates. And we think that they've started commenting about they want to start doing quantitative tightening, meaning actually unwinding some of their holdings of mortgage bonds and treasuries. Of those things, the first two, the two that we know that are going to happen, are positives for interest rates in the longer term. As we see what happens with inflation, and it's going to moderate throughout the course of the year, that tells us that rates should stabilize and potentially decrease. The wild card is if the Fed gets a wild hair up their ass and decides they're going to start selling their mortgage bonds, rates could go significantly higher. So that's the big wild card to watch. But if I was to guess, they're going to get the slowdown in inflation that they want. They're going to think that they did it by raising rates. And the reality is supply chain issues and all of the stimulus money being spent and just petering out is what's going to cause it. But no way of knowing. But Jeb's answer is pretty much right if you're going to place a bet right now with what we know.
Right. Which I'm not even going to bet on my own.
No wagering.
No, because you just don't know, right? Let's see here. Select. You're asking a question that we kind of addressed. Interest rate lock if a new build is expected to be complete in May or June. Again, Josh said, get your 30-day lock, see what that lock's going to be. Get your 60, 90-day lock, see what they're charging, see if it makes sense to, based on the potential of the market moving in either direction, if that makes sense to you. There's not really we don't know what's going to happen, right? A lot's going to happen between now and May. You got the Fed, right? The next Fed funds meeting, I think, is in March. They take April off and then they come back in May. So depending on what they do in March and how the market reacts to that could dictate whether or not they do another quarter point or half point or whatever they decide to do in May, which may or may not impact rates in a negative way. So hard to say. I don't have an answer there at the moment. You got to do and see what makes sense to you.
Got a good one, quick, easy one. Richard Rivera says, question, just got a promotion at work. At what point can I use the additional income toward my pre-approval? Immediately. Like, you don't even have to have received it. We need a verification of it from your employer, and we probably need to get a pay stub at the new pay rate before you close. But in terms of factoring it in, if someone gets a raise from 70,000 to 75,000, as long as we can document it and know it's coming, we can take that into account immediately. The only instances where that is not the case is if you have variable income. So let's say someone works 40 hours a week and gets a bunch of overtime. It makes it really hard to average that in if your hourly rate increases. So, but even then, if your employer is willing to cooperate with some additional numbers, we can use it. So for the most part, immediately, once you know what that raise looks like.
And we have been proven wrong. I guess Ben Carson is alive.
No, untrue.
Huh?
Untrue.
He was on Fox 2 days ago.
What might have been a recording of him because he's been very dead since January of 2021.
I don't know. People are arguing it.
Is he really alive?
They're saying Herman Cain died.
Did I get that's racist? I got my guys confused.
Yeah, but I think Ben is still out there.
All right. Well, which one was Herman Cain? Ben ran for president and ended up got the consolation prize as HUD secretary. What did Herman Cain do?
I don't remember.
He was a Tea Party activist. All right.
All right. Well, somebody's dead, somebody's not, and we're sorry
one
for
is
the
and
guy.
one's not. Yes, and I apologize for confusing the two of them. That was rude.
Yeah, they probably just Twitter's probably out there pushing that he died now. Let's see here. What are we doing here? Okay. So do you guys think investors will slow down when interest rates go up? Hard to say. Here's the thing. From an investment standpoint, investment to investment. So let's talk about, for one, you've got hedge funds, right? Hedge funds and that whole side of the market that's cash. So that the rates going up doesn't affect them. But you also have people that are selling investments, buying other investments, right? A 1031 tax exchange. The problem there, and I've had this conversation with several potential investors that are looking at selling something, saying, because you only have a limited time. So when you sell a property, if you're going to defer the taxes and put it into another investment property, not have to pay capital gains on it, you only have 45 days to identify the properties that you are going to purchase, and you have essentially 6 months to close on them. So what investors that are considering selling, what I hear a lot of is people going, oh, as soon as these moratoriums are over, all these investors are done tired with done with renting, and they're going to sell their properties. Okay, so that's a reasonable thought, but let's think about that. Now, are these investors going to want to pay a huge percentage of their profit, if you will, on capital gains? Probably not. Right? Most investors are in investment properties and doing 1031s to avoid any potential taxes. But what happens is when you're considering selling something and buying something else, there's got to be something out there for you to buy. Right? And so what investors are doing at the moment going, if I sell this, inventory is so low, I have nothing to move my money into, and I'm not going to put myself in a financial position where I'm going to have to end up paying capital gains on this. So you're going to have investors that aren't going to move money for one reason or another in itself because of supply. Interest rates, because rents are going up, a rise in interest rates and the rent going up kind of offset each other to some extent with regards to that difference in what the payment would be. So I don't know that investors are going to necessarily look at the fact that, hey, rates are up, I'm no longer a potential buyer of investment real estate, because they're now able to get more money for that rental because of where rental prices are going with inflation and a lack of rentals and all of these other factors. So it's a really difficult question to answer. I think it's going to be a case by case basis. As an investor, are you going to hold on and not do anything? But the answer is, the reality is that real estate's the best hedge against inflation. So if you believe inflation's real, people need to park their money somewhere, because if you hold it in cash, you lose value. You put it in equities in the stock market or whatever, you might see a decline, because that's what we've seen historically when the Fed starts raising the Fed funds rate. So real estate's really the best place to park your cash at that time. And so I don't know. I mean, Josh, I kind of ran around in circles there and didn't really get to my thoughts. I guess my thought is no, I don't think it's going to affect them yet. If rates get up in the mid to high fours, maybe. But I think the offset with the rise in rents kind of helps with that rise in interest rate. But Josh, what are your thoughts? You own investment property. What are your thoughts?
I don't care what the interest rate when I'm buying, but the interest rate is an element of your analysis of what your cash flow is going to look like. We got in just in the nick of time, refinanced the property in Orange at 3.25. So I've got strong positive cash flow on that property. So cool, makes sense. Keep the property, don't sell it. If rates are at 4.5 and you lose, $150 of that cash flow, maybe you decide not to do it. But let's look that there's two different groups of investors. There's the mom and pop investors like me that have a house or two or five or six, and then there's institutional investors, the big hedge funds, and they're looking at it from a very different perspective. We talked about what yields are on rents. You buy a $300,000 house and pay cash for it. That thing rents, well, shit, Jeb, you just showed me one the other day. $165,000 house was at $1,400 a month rent.
Yeah. 165. No, yeah, like 1,400 or 12. It's somewhere in there. Yeah.
Call it 1,200. That's $14,400 a year on a $165,000 investment. That's like a 7 or 8% yield. So when you can put money elsewhere and get 4.5% yield, it still blows it away, and you're still getting capital appreciation with it going up. You have some tax deductions there. So, and I think from a bigger perspective, the hedge funds are looking at it like they don't believe that interest rates are going to stay high for a prolonged period of time. So you would only be selling or liquidating assets if you thought there was somewhere that you could permanently park money and get similar yields. So it will absolutely affect mom and pop investors that are looking at acquiring new rentals. But as you said, Jeb, the ones moving money from, hey, I have this and I want to rotate into this, it's going to have much less of an impact on it.
There you go. Richard just got a promotion at work. At what?
We already answered Richard's question.
Oh, we did?
Groundhog Day, bro. It's Groundhog Day around here.
All right. Well, there we go. Where was I when you answered that question?
In a different headspace. Let's go with this
I
one.
guess so.
Maria has a good one here. And it's I understand where the thought comes from, but if I want to buy a second property as my primary and rent the one that was my primary, am I obligated to refinance my first home that I want to rent? Absolutely not. When you are doing an owner-occupied loan, purchase or refinance, you're signing an occupancy affidavit that says that you intend to occupy the property as your primary residence within 60 days of closing. You are not signing anything saying, I'm going to live in this residence for the rest of my life as my primary residence. So if you did the loan, lived there for 1 month and moved on, and the lender became aware of it, they could press the issue. Again, I've never heard of it happening. So I wouldn't worry about it. But if you've had that loan for 6 months, 12 months, 24 months, I wouldn't worry about it.
There you go. So Digital Cash Cow wants to know if you're dyeing your beard for more experience. They've caught on to you.
Does he mean like bleaching out the gray parts? Here's the thing. You see this lovely head of hair? There's like 1 or 2 gray hairs in this entire thing. This just is permanently turning gray. So I don't know. I don't know how it works. It's a cruel
and so
joke.
the deal with the beard, guys, is so I did dry January, didn't drink. I've decided that the beard is going to go until I have a drink. So it might be 6 months, might be a year, might be next week. I don't know. But it's going to go. It's going to just grow. We're going to see what it looks like. This is the longest
it's going to grow until his wife says it's not going to grow. That's what's going to happen.
So no, she likes it. So this is just going to just go. I told her we're going to start a trend. We have shocked the world that people think that Ben Carson is dead. So we've
is it trending? Is it trending worldwide yet?
I don't know, but everybody thinks we're nuts. So
no, I'm not nuts. My mistake is I Googled and I recently switched to the Brave browser because I heard that Google is like going to steal my identity and do crazy stuff.
Bro, are you on DuckDuckGo?
No, I'm on Brave, and I'm over here, and it pops up, and it actually said his term as the 17th United States Secretary of HUD ended on January 20th, 2021. So since I had confused him for Herman Cain, I concluded that he died in January of 2021 when his term ended.
So good. Let's see here. I'm reading some questions. Josh, you find something, put it in there.
I want to know, Jeremy's wife brought him cheeseburger pizza while he's working and watching. What do we need to do to get cheeseburger pizza delivered here while we're delivering the show?
Nothing. I don't think much. I could make that happen right now, Josh. Do you want cheeseburger pizza?
Yeah, I think it would be excellent.
All right, let's see here. Get into some more questions. We've got a lot of comments.
Here's a solid one from Willie.
All
He
right.
says, Jen, next to the dash on me gravestone, I would like to read, mortgage is a lot like kayaking. If you stop paddling for even just a little bit, you could drift into a bush or worse. I'm not sure where you're kayaking that there's bushes that you would drift into, but we got to find you some new streams.
That's the Neuse River in Kinston, where I'm from. You could easily drift into a bush.
Oh,
Let's see here. We have God, man, the people really think we've killed Ben Carson here.
listen, I said nice things about him because I liked him. I liked him more than Herman Cain, but I'm not happy that Herman Cain is no longer with us.
So let's address this one. So trying to sell our house in Hemet, but it doesn't seem to be moving. I feel like I'm seeing other houses fly off the shelf, but mine is just sitting. So here's the deal. Typically, what I tell sellers or tell buyers that are looking at property is if your house isn't selling, especially in a market at the moment where things are moving pretty quickly, there's usually one of two things happening. One is it's either overpriced, or two, there's something external factor that there's something wrong with it. Does it back to a freeway? Is there something going on with the property that people don't like for one reason or another? But usually then it still comes down to price. Even if that is the case, it basically ultimately comes down to price. So obviously, you're under contract with somebody, so you can't really get advice. But what I would tell you is, where are you coming up with the pricing of the property? Is it based off your number? Is it based off what the agent's recommending? What is the agent recommending at this point? And here's the thing: how long has it actually been sitting? Has it been 2 weeks, or has it been 2 months? Right? I mean, the problem at the moment is that everyone thinks that their house should sell in a week or a weekend because that's the market we're in. Okay, in some cases it should, but you have to understand that that's not always the case. There were a couple of homes that I sold last year that didn't sell in 7 days or 10 days. It took 30, 40 days in some cases to sell some of these properties. And guess what? They still ended up closing where we thought they were going to sell initially. So you've got to weigh all of the factors as to why it might not be selling. But if you trust your agent, what are they saying? Why is it not selling? Are you getting showings, but nobody's making offers? Or are you not even getting showings? Because that's important. If you're getting showings, but you're not getting offers, then it's probably something to do with the property. If you're not getting any showings at all, then maybe it's the commission you're offering, right? Don't want to go there, but maybe it is, right? If it's a low commission, figure out how it's being structured on the other side. As an agent, that's something that people look at. Agents don't show properties with super low commissions, especially if there's a similar property offering a higher one. So there's all of these things that could be the potential problem. So, you need to dial in and figure out which one of those it could possibly be.
Couple good ones here, Jeb, from Johanna Baldwin. In a small town in Oklahoma, average 2,000 square foot house was 150 grand. Now they're all over 300, and it's a minimum wage community. Let's go back and look at that example. In like 2010, when we couldn't talk anyone into buying, homes were incredibly cheap. Maybe that was about the point when they were 150,000. Since that time, the economy strengthened. People believe in real estate again. Rates were dropping from the 5% range down to the 3 or 2.5% range, and incomes were increasing, and minimum wage has increased through that time frame. So just keep an eye on percentage of household income going to the median house payment versus what the actual purchase price did for the home. The homes were probably undervalued when they were at 150, and they may be properly or slightly overvalued right now, but it probably makes a lot of sense when you're looking at the decrease in interest rates over the last 7 to 10 years. And then she follows up with another question: why would you refinance? Isn't that basically starting from the beginning again? It can be. Right. Yeah, it could. Doesn't have to be, but it can be. A lot of people the last few years, most of my clients, if they're 2 or 3 years into a loan, they'll be like, give me another 30 year. I don't care. If they're 7 or 8 years into a loan, they don't want to just start back from the beginning. You can go a 25 year, 20 year term, a 15 year term, And you can also, with most lenders, pick a custom term. So if you're 4 years into your loan, you got 26 years and 2 months on your current loan remaining, we can go 26 years and 2 months on the new loan. So if the reduction in interest rate makes sense, you can absolutely do that. Jeb, if you don't mind,
Yep.
I'm going to jump right into another one here. Sunny Crack Beats, love the name. His avatar's boring, but I like his name. Can you please talk about Fannie raising DTI to 50% in 2019 and the explosion in prices since? My lender told me most of his first timers like us have a 45 to 47. So a couple false premises here. They didn't raise anything to 50% in 2019. We've had 50% forever. If you go back to 2003, 2004, we could go to 64, 65, 66% for really well qualified, high credit score borrowers that were doing a rate and term refinance where they were just lowering their payment. We no longer have that luxury because of some of the laws that the government has passed post meltdown, but we've had 50 forever. If anything, since 2020, probably all the way back to 2019. We're now on version 11 or 12 of Desktop Underwriter, and they continue to refine and tweak their algorithm. We have less and less borrowers that are able to go to 50%. I tell most people it's 45%, and if you're well qualified and Desktop Underwriter likes you, it may let you go to 50%. I have a client today with a 730 FICO. They wanted to do a 3% down, and we couldn't get them approved at a 47, 48% DTI. 5% down, now it approves it at just a hair over 45. So it's not as simple as saying, oh, everyone is a high DTI. Our first timers, we talked early in the show, our entry level buyers, our buyers buying lower priced homes under 500,000 are often pinned up near the max of their debt to income ratio, less so with our people that are buying $1 million, $2 million houses. Those people generally have some wiggle room there. But anyone that's telling you that there was some sort of conspiracy theory where Fannie Mae changed something in 2019, allowed a higher DTI, and now people start paying more for homes, it's just not the case. We've had the ability to go to 50% forever. It used to be much easier, where I would tell people, most people can go to 50%, and if you're kind of iffy, you're going to be limited to 45 or possibly even lower. Now we tell everyone it's 45%, and if you're really well qualified, you might be able to go to 50.
There you go. Good stuff. Cindy Juggle Goddess says real estate agents and mortgage lenders are equally smart. They're not all equally
Most
smart.
are dumb.
Let's
Be
clear
dumb.
here.
Let's call a spade a spade. Most are
But
dumb.
if you do want an expert, if you will, there's a link in the description there to get connected. Regardless of where you are in the United States, many of you guys reach out, ask us for people, and then come back and saying, "Hey, they were great, got pre-qualified, got hooked up with a lender or realtor, whatever." So if you need somebody, click on that, and we will get you connected to somebody that can guide you in the right direction there. But let's talk here. So there was a couple questions here I wanted to go over. Man, people really they're pissed that you said Ben Carson's dead.
I love Ben Carson. Do you have any idea how happy I am that he's still alive?
We're gonna get sued tomorrow for false for destroying
defamation.
He's probably been searched more on the internet tonight than ever in history. Let's see. Are beards the in thing now? They are not psyops. They are definitely not. They were the thing years ago. We just caught on now. Here we go. Here's a good question. Is it wise to get a real estate attorney to look over paperwork contract if you are working with a realtor? Does a realtor carry E&O insurance or similar to protect sellers and buyers? So brokers in the state of California, I don't know where you're located, Jeremy, but brokers in the state of California are required to carry E&O insurance. So I'm assuming that is probably required regardless of where you are in the U.S. But yes, they are required. Should you hire a real estate attorney to look over paperwork contracts? So some states, attorneys are the actual people that deal with the contract. So in some states, you don't necessarily have to hire an additional person to do it. An attorney is the one looking over it. But understand, these contracts were essentially written by attorneys, and they are there to protect the seller. They are there to protect the buyer. They are there to protect the broker so that everybody is getting protected. Primarily the broker, right? I mean, that's why every time there's a lawsuit, there's a change or another disclosure, or what have you, that comes to fruition, if you will, with the real estate purchase experience, but not necessarily. You don't really need an attorney to look over stuff. Now, what might be you might want to get an attorney to look over is that if you're buying a unique property in some form or fashion, right? You're buying a property that's on leased land or something along those. You might have an attorney review the lease document, right? Something that is not typical of the transaction, but every single, like here in California, every single buyer or seller in the state of California that uses a realtor uses the same purchase agreement, and essentially has to sign the same disclosure. So the only things that can be changed are the certain nuances of the agreement, which are very clear in there. So if you have a good agent, they can explain to you that contract, and there's not really a need for that. But if you're not familiar with it, or you're buying it out of state and not familiar with that purchase contract, maybe you have someone. But I think typically, my clients aren't having an attorney review it, so I don't know that it's necessary. Let's see.
A couple
So,
of good ones.
So Con has asked this question a couple times. Contastic. Lender is giving me a 3.99 with a premium to rate lock at 4.375 for 9 months. So I'm not sure what the how you're getting a premium, but your rate's going up. I can float down with within 30 days of closing, expecting house to be delivered by September or sooner. Should I lock the rate now? So here, go ahead, Josh. Yeah, I'm sure you want to jump on this one.
I was just going to say plus or minus, it should be like 3.75% today. So 399 is a premium. Normally a 0.25% increase would be about a point. And that doesn't sound unreasonable. I'm not saying the guy's giving you a bad deal. I'm saying that's sort of the premium for that long lock. I would love to know the details of the float down, because there's worse things. You know what I'm saying? You're saying, I am just saying this is my worst case. And if it gets better, I can get better. So there's no free rides. You're going to pay for it in one way or the other. But it's insurance, and some insurance is worth buying. I wouldn't necessarily hate this, but I would want to know the details of the float down and how it works.
All right, there you go. Hi, y'all. They're building senior homes less than a mile from my house. Good thing, bad thing, nothing. I mean,
do you want to tell them what they're doing in our office complex, Jeb?
what are they doing in our office complex?
So our complex has 1, 2, 3, 4,
tearing down the building and building
5 buildings. One of them is getting torn down, and that whole corner of the parking lot is going to be senior living. If you look at it,
I thought it was going to be a parking structure.
It's going to be both. They're going to take that whole thing out there, and because they're doing away with the parking, they have to build a parking structure. So they're building the new senior center,
okay.
And they're replacing the parking lot with a parking structure.
Got it. Okay.
And the reason for that is just yield. Unfortunately, we lost my dad in 2020. About a year before that, we had to put him into a facility, and just half mile this way. So we're literally where we sit in my office, we put him in a bitchin' facility like a half mile away from here. The guy was a home builder, and he didn't like the numbers in home building, so he started building senior communities. This was 3-story, lovely. Everyone either shared a room with a bathroom or had a private room. So my dad had a private room, the bitchin' bathroom. It was as nice as his condo that we moved him out of. And you look at it and you start doing the math, like what they charge for rent for the room. Like, I don't know that they're making a ton of money off of the care and everything that they do, but they own the real estate. They have all the benefits of other types of real estate, but the rent for a room is pretty absurdly expensive, so that you can get the care, which is kind of like a loss leader. So it's just another yield play where people who want to own real estate and are comfortable running a business attached to it can make money. But I think Jennifer piped in here and said, hey, it's not a bad thing. These people are quiet. They're not out there partying. You don't have a lot of traffic, riffraff, crime and stuff going on. So I don't see how it could be bad. It makes sense from an economic perspective why we're seeing so many of these go up with an aging population.
There you go. Let's see here. What are we? We've got 15 minutes or so. If you hadn't hit the like button, I would ask that you do that. We're at 151. My goal tonight was 5,000. We're way short of that. So at least you can get me to like 500. I mean, there's only 248. You're going to have to hit it twice. If you hit it twice, it kind of I think it takes your like off. So then it gets really weird. I just ramble. It's going a different direction. But anyway, we're going to thank Jennifer. Jennifer gave us $25. Jennifer, thank you.
How many times
Jennifer,
have we told her to stop giving money for you to hoard and not buy 805 for the two of us?
dude, I'm not even drinking. I'm growing a beard, bro. It's going to go to beard product. I'm going to get some nice product in my beard.
To
be
bleach
nice.
out the parts to gray so that you can look wiser?
I mean, this is the direction I'm going. This is it. So guys, it's going to get long. It's going to get crazy. I just need the support. And you can do that by hitting the like button. Jennifer saying thank you. She got into a house. Hey guys, give her congratulations. In the chat. She's going to bail on us really soon. We're going to need another moderator. It might have to be Willing.
She's
Maybe
not
Willing
interested.
should be our moderator.
Oh shit, we would be in trouble.
Should we put Willing as the next moderator? That should be a question that I'm asking you guys right now. Should he go be promoted? She be promoted? Should it be promoted? Are you they, them, or
yeah? What are your preferred pronouns?
Yeah, what are your pronouns? Put them in there. I need to know so I know how to refer to you. Wow, this just got really.
It's funny
really
now that you said that. What I can imagine is the what's the character on Billions that doesn't claim to be anything, non-binary.
Never seen.
I see that. That's you've never seen Billions.
Never.
Billions was good. I lost the plot a couple years ago, but it's good.
All right. We had some good questions here. We got a lot of people saying Ben Carson's alive. All right. Cindy's saying, are you seeing any trends that people are selling their home and moving abroad, becoming expats? I haven't personally. In fact, most of the people that I've had leave the state of California have gone to Texas or Arizona. In my experience over the last 2 to 3 years, I would say on average, every year I at least have 3 to 5 clients that sell and move out of state. You always want to know where they go. Typically Florida. I mean, not Florida. Actually, Florida is one of them, but Texas and Arizona are the big two. Idaho over the last couple of years are the main ones. But that's not anyone leaving the country that I'm aware of.
Yeah, I see these stories. You see these stories online where people move to Costa Rica and they live off $700 a month and it looks awesome. They're eating lobster tacos and surfing every day. I want to know how that works because I'm down for that.
Bro, you don't surf, and
I would start.
Well, that could work. So Emilio wants to know, every time you ask a realtor when's a good time to buy, they always say it's always a good time to buy. Josh, why would one say, first off, it's not always a good time to buy. So let's be clear on that. But if your goal is to own real estate long term, right? Is it a good time to buy? I mean, what do you think about that question, just in general? I mean, the guy has a hell of a mustache. I will say that.
A fantastic mustache.
I mean, it makes my beard look very, very feminine. But
he looks very concerned, like he's peering through your soul. But what I would say, the answer I always give to this is real estate is the leveraged investment for the common man. So I don't consider myself a common man, but I've also never bought a stock or any other investment on leverage. Bought lots of real estate using leverage. So people love to tell you, oh, the average return on real estate is 3.5% over the last 147 years, and the stock market gets you 7%. Well, cool. Did you use leverage to make your 7% be 30%? No, but most people put 3 or 5 or 10% down on their house and they get that 3.5, which for those of us in California is more like 5 to 7. And with 10 to 1 leverage, that's 50 to 70% returns in the early years. And that's why it builds wealth. So there's obviously going to come a time when real estate may not be the best investment. For those of you that question me on this, we will publish the PDF that business partner and I wrote in 2005, telling people to be very, very cautious about their real estate investments. Don't add to their portfolios. Don't enter the market based off of things that we were seeing. So the answer is not always yes. Right now, I would say it's a yellow signal. at the beginning of 2021, even before we saw the last year of 20% appreciation, if we go back to this time last year, we're sitting at, 2-something interest rate, maybe 3% interest rate. Values are 18, 20% lower than they are right now. That's a green flag. Jump into the market. Now it's definitely a yellow flag. I would not want someone who is a marginal buyer extending themselves to buy into the current market. We had a couple of questions tonight. Hey, should I wait and sit it out a year, or should I jump in and do it now? For most people who have decided they've reached the stage in life where they are stable enough in their family situation, their job situation, and they know what part of the country they want to live in, you should be buying a house so that you can start that process of the leverage and time working in your favor. So does that mean it's always a good time to buy? No, there could come a time where the winds blow in a different direction, but right now it's a yellow flag. Those people who've reached those stages of life still should be buying.
There you go. And I didn't even have to say it. As a real estate agent, a mortgage guy said it. Listen to that. A mortgage expert. But anyway, it's not always a great time to buy. But again, if it's the right time in your life, make the move, right? There's a lot of people sitting on the sidelines that have been sitting on there a long time. And there's just as many people, smart people out there that think that there's another 2, 3, 4 years of this whole thing. And there's also equally smart people that think there's not. So you got to go with what works for you financially and hedge your bets, if you will. So it's not a easy, straightforward decision for everyone. Some people it makes more sense than others. For me, I got a growing family. Not adding any more people, but boys are getting larger. I need more space. So for me, buying a house makes sense. That's financially, it makes sense. Because I don't plan on going anywhere. I don't plan on selling the other one. I mean, there's a lot of things that factor into that conversation when making that decision. So my thoughts, but simple name, she gave us a $5 super chat. So thank you for doing that. Much appreciated.
Where did she declare her pronouns?
Let's see. Right above, right here.
Okay. All right.
Simple name. Simple name. Let's see here. Danny De La Rosa. So I met Danny at a seminar a couple weeks ago. He's a real estate agent. Is a fan of the channel, came up and said hello and said, showed support. So thank you, Danny. You're awesome, man. Appreciate that. Let's see here. What do we got? We're at 153. You guys are slacking on the like button, but that's okay. I'm used to it by now.
Listen,
I went there.
Cindy Juggle Goddess came with some good information to protect me. Ben Carson did get very ill with COVID, but he recovered. My memory must have just known that he had a serious case of COVID and almost didn't make it.
Yeah. Eco, will the SB 9 law for California keep single family homes in demand? Yeah, I think so. I mean, I don't think, I don't think we're really losing demand at the moment. So I don't know that demand is really something that we've got to address at the moment. Demand is clearly outweighing supply. But there will be a higher demand, if you will, for homes with larger lots because of SB 9. And there has been demand for larger lots prior to SB 9 because of the state allowing ADUs some year ago. But now that you can lot split and all of that stuff, there will be additional demand for those larger lots. Not all single families are the same because not all are built like that. So yeah, I think demand will, especially in densely populated markets where if you see an area that has a lot of cars parked on streets and that sort of thing, like a multi-generational type living situation, I think it's even more, that's something that it's even probably more demand in those areas because of that multi-generational type living. Just my thoughts on that one.
This one's going to be a tough one to answer. There's not really a right answer.
There we go.
Cut it out. Cut it out, bro.
Did.
You're trying
I saw this one and this is an easy answer.
You're trying to censor my question. Should I wear my herringbone under the collar stealth or whip it out during negotiations when I'm playing hardball?
Dude, you should come to the negotiation with it out. I mean, it should be when you make it should be out. Like, you want to know these? I'm serious. I came here to do a deal. Herringbone's out. You might even have a rope. You might even need 2 chains.
The
And have
pole,
a
2
rope.
chains. He just threw 2 chains in there.
You might have a rope and a herringbone.
No, you
And
can't.
if you want to get like real, like look at the picture of what's his name? What's the quarterback for the Bengals? Drawing a blank.
Joe Burrow.
Oh, Burrow. Look at Burrow. The Rock posted a picture of himself like from back in the day, and he posted there's a meme, and it's Burrow beside him, and they're both wearing the chain with the big medallions on them. That's how you go into a negotiation. Like, let's see if I can find it while we're out there.
So here's all you need to know about Jeb and I. Jeb had a little herringbone. I had
not a little, bro. That thing was thick.
It was like
that thing was thick,
1/4 inch, bro. I had a big Dookie Gold rope that this guy wouldn't even know what to do with.
Dude.
I wore it with my Bulls starter jacket.
Hold on.
My Jordan 1s.
Let's see here. How do I share this? Let's go.
Just so you know, Willing said you cannot.
This is how
replace.
You go into a negotiation right here. The Rock put it out there on Twitter, basically saying just 2 badasses with a strong chain game. Look, you go into a negotiation like that, you don't lose.
I'm going to tweet out the 3 of you side by side with you with your
I will find that picture and I will do one.
Say
if we had enough time, I'd go find it.
Hardcore negotiators. But Jeb, what I was saying here is Willing popped in and says you simply cannot replace a Gen Lego, but Willing would be honored and would honor Lego in every way. So thankfully, Jen said she's not going away, so we don't have crazy nonsensical gibberish taking over the show every week more than it already has.
I don't know. I mean, I think it could be interesting. I do have a question though. And this is a real question. So if you guys will just put it a yes or no in the chat, would you be interested if we did something like this and you guys had interest in asking your questions live? Like, we gave you a link to come into StreamYard and actually ask your question live. We could address your question. This wouldn't be every time. Maybe once a month we would do this. So instead of reading your question, you could actually come in. Your face could be on the screen. We prefer that versus staring at, just a blank box there and answer the question. So if that's something that you'd be interested in, let us know. I think it's something that is interesting, could add a little bit of change to the show, and you could get to see who some of these people are, that you're seeing ask the questions. Anyway, where are we at?
Let's throw this one, Jeb. Where in the heck? I just had it here. So Danny De La Rosa, I've been hearing people talk about an increase of foreclosures this year. What are your thoughts on this? So your favorite friend over at Reports on Housing throws the Orange County foreclosure report in there every week. Mm-hmm. So I'm going through all of the cities in our county. There was 1 active foreclosure or short sale in Anaheim Hills or in Anaheim, 1 in Huntington Beach, for a total of 2 in all of Orange County.
Man, they're really adding up. I know he's in San Diego. I don't think much is going to come on there. I mean, you heard Brian talk a couple weeks ago, and Brian basically, and we're talking Buffini, a mentor of mine, but basically he came out and said that he does think that the end of forbearance, it has an impact on the market, and not in the way that people think. A lot of people think, well, because of more the forbearance is over, that people are going to foreclose now because they have to start making their payments. No, the reality is these people have a lot of equity that's been gained over the last 18 months to 2 years. They're not in a position where they're in distress, like equity wise. They might be in a distressed situation because they can't afford the payment now because something's changed with life. They've decided, hey, I'm not going back to work. This is not what I want to do. I need to sell my property. So that is probably a bigger, not concern, but a bigger player with regards to properties coming on the market than anything considering foreclosure. So people ending forbearance and need to figure out what they do. How do I get, how do I save my equity and go rent something, or how do I buy something smaller? Okay, I got to sell this property because I can't do the payment. That's more realistic of what's going to happen. Let's see here. Carrie, would you guys put $1,000 towards a payment each month to own the property that your mom lived in? tough question without knowing the details and why you would be putting $1,000 each month to own the property. I don't know that I understand the question entirely. Josh, am I
No,
missing something?
I'm not following either. Hopefully, Carrie's still around and can give us some more insight into who else owns the property, who's making the payment. You're just going to make $1,000 payment to help your mom until she's gone, and then you'll own the property, or are we off base? Is there something else there?
Yeah, I think that was. Yeah, no, I think we just need a little bit more info. Seems like the three people that answered the question said yes, they would like to come in. So I feel like we should see Jennifer at some point. So Jennifer, you probably got to make a debut because nobody even knows who you are, or maybe you're not. Maybe you are willing to, and maybe willing is like 5 people, and just making us guess what's going on here. But anyway, guys, we are reaching the end of the show. Appreciate all of the support, all of you guys being here. Without you guys, none of this happens. I am going to reference the chat again. There's a link in there if you want to register, doing a free webinar on the 17th of this month, 6:00 p.m. Pacific Standard Time. Register for it. You don't have to show up, I guess, if you don't want to, but it's not going to be, you won't have access to it after that. So it's going to be live. We're going to do it. Go over the home buying process and hopefully guys get you dialed in for 2022. Josh, anything you want to add? Anything I'm missing here?
No, it's just funny in reading through and answering the questions tonight. What kind of struck me is the last couple of years were pretty darn easy. Once we got to the far side of COVID, where you knew the market was fairly normalized, we knew that with low interest rates, good affordability, that people were going to be buying homes and home values were going to go up. Now there's some really smart people putting up some really good arguments. And when I say really smart people, we do not mean Reventure Consulting. We mean people that actually follow the market and don't engage in clickbait and manipulate numbers, but really smart people who have some concerns. And it's important to look at those. It's important to look at your market and see how their concerns impact what's going on in your area. I expect more of the same, but we always want to look and scan the horizon, and we want to make sure that people aren't making panicked buying decisions or FOMO decisions of I got to jump in at all costs. You want to make sure it's the right point in your life, that it makes sense, you're financially stable, you're going to be located where you are for a longer term time horizon. And if so, I don't have any problems with someone buying a home this year, but you definitely, you want to be cautious and make sure you have all your ducks in a row.
No, great advice. I mean, that's always the case. Real estate's local. Pay attention to what's happening in your market. Again, buy for yourself. Don't buy for other people. Don't take advice of people that aren't actually doing, what they're preaching in one form or fashion. So with that said, we'll be back next Wednesday, same time, 5:00. Hope to have a podcast link for you guys really soon. But we appreciate you guys being here. We appreciate the support, and we will see you again.